This is the disclaimer for Reabold Resources. I urge you all to read that in great detail, and I'll be asking questions on that afterwards. So just very quickly on Reabold, every time that we've presented at Turner Pope, we state the same strategy, and I'd like to reiterate it again. So the strategy for Reabold Resources is to invest in low technical pre-cash flow upstream oil and gas projects, where the capital that Reabold provides unlocks that project with near-term drilling and a quick cycle time to monetization soon after drilling success. Sorry, can you hear me now? No. Okay, I'm going to speak up a little bit. Is that better? Okay. Where if Reabold has success, there is a quick cycle time to monetization on that underlying asset. The reason I mention that is this is very much more the type of approach that an investor would have towards running an oil and gas company, precisely because Stephen and myself, my co-chief executive, are indeed investors, having looked at this space, and we are trying to really have our shareholders exposed to the steepest part of the value creation curve by deploying that strategy. And in many ways, the difficulty that exists in the market is precisely the opportunity we're trying to give to our shareholders. Now, on this slide over here, this is a slightly new one, we thought we would highlight one of the key factors that has lent support through the deployment of the strategy over the last 18 months that Stephen and I have been in the company. And one of those factors has been an incredibly supportive institutional shareholder base. And that institutional shareholder base has come in over the 3 raises that we've done and are made up of the institutions that you have here. Now, not only is it unusual for a very small cap oil and gas company, although I jokingly did say I think that's probably a mid cap for an AIM-listed E&P company, but that's by the by. Nonetheless, to have had this quality of register is an indication of the support and indeed the delivery to date on the strategy that I just outlined. All right, so hopefully that's a bit of background for those of you who've been supportive of us and a quick update, but also for those who don't know us in terms of what we're about. So, as I said, Stephen and I come from the investing side of the world, and that's why we have this different approach in terms of thinking of building an oil and gas company. This is much more about money in and money out, as opposed to necessarily production targets or indeed reserve targets. What I would like to show is in the 18-month period that Reabold has been running, how, or I should say, since we've been involved with Reabold, because it was technically a shell before that, how we have exposed our shareholders to $394 million of NPV, because we're able to buy into pre-cash flow projects so very cheaply, given the difficulty that exists in the market right now. So this is just a summary again of those 3 key points that we adhere to in the strategy of Reabold and what underpins each of the projects that I'll talk about in more detail. So in the projects, this is a chronological list of the investments that Reabold has made into the underlying companies or projects for which there's a near-term drilling campaign that I'll talk about a little bit more. Each of the projects are very substantial, if not transformative, to the Reabold shareholder and have a slightly different balance and mix as I describe them in more detail later. The first investment we made was in Corallian Energy, where Reabold took a 33% stake, and we would argue that without the investment that we made in Corallian, the Coulter well, which spud on the 6th of Feb, would not be being drilled, and looking forward to an exciting result from that, we hope. We also made an investment in Danube Petroleum, where we created a new entity to gain exposure to low-risk drilling for gas in Romania. Reabold California was a third investment, but the one where the most activity has taken place. Because in this project portfolio, we have 3 distinct areas. We did well workovers. They are now in production and demonstrating the monetization and quick cycle times of our investment. We've had 2 successful wells on West Brentwood, and again highlights the fact that the successful wells convert into production quickly and therefore quick monetization for our investors. Grizzly Island is slightly more exploration-y in nature, and we'll be drilling that later in the year, but the next well in California will be on Monroe Swell. Probably worth highlighting that the workovers that we did here not only generated cash flow in and of themselves, but helped to de-risk the opportunity and improve our understanding of the Monroe Swell well that we will be drilling shortly. The last investment that was made was in Rafflin Energy. Reabold took a 37% stake to go after the West Newton appraisal well, which is approximately 187 BCF mean estimate for, as I said, an appraisal well. So we've already had the successful gas well drilled there. There is some oil potential, but that's not included in these NPV numbers because, again, that's more exploration-y in nature. But it will be tagged in that well that we drill next, hopefully in Q1 of this year, in East Yorkshire. So this is now a graphic of that same investment program I talked about, but in chronological order of the drilling activity that took place. And indeed, I'll refer to some of the resequencing that took place as well. So the first thing that you see up there is clearly the workover wells. I mentioned that. But then you see two successful wells on West Brentwood, VG3 and VG4. That was a little bit different to what you might have seen a few months ago because we accelerated the VG4 well, given how important cash flow acceleration was for us at that point in time. So we deferred some of the activity in California on Monroe Swell to bring forward VG4. But there was another more nuanced factor that came across from that. VG4 tested at rates not really seen in the sub-basin of the Sacramento Basin. And it was at rates that averaged 480 barrels a day. That gave us some really important insights into completion and indeed potentially going back to VG3. Itself, VG3 was a successful well, having produced at something like 150 barrels a day. And in this region, that is extremely quick paybacks for onshore US. This is very old technology, very simple drilling, very quick to production. Once you get it producing, you sell the oil in a very established network that's been going for decades in the region. That's why it is so attractive to go after these opportunities. But nonetheless, just to stress and reiterate again, when we saw the 480 barrels a day of production, it really not only vindicated our thinking of that, but probably reappraised our own view of the value of that underlying asset. We'll be drilling Monroe Swell next in the campaign. I'll talk about that also a little bit more. But that field is similar in nature and characteristic in many ways to West Brentwood, but it is aerially more extensive. So with success there, we can go after a more aggressive campaign of production than we are necessarily able to do on West Brentwood. As I mentioned, we have we have the Coulter well, which has spud. So you should argue that I should have switched the two wells around if I'm going in chronological order of activity. The difficulty I've got is I don't know which one's going to come first on the result, because this is about a 30-day well. And I have to say, we're very excited that it has spud and that we look forward to the hopeful success that will come from that. Followed by the two wells in Romania and in the UK. And finally, we have Grizzly Island going back to California some stage H1 of this year. This is a little bit more of a graphic of the Sacramento Basin of the assets that we have, and is essentially just east of San Francisco, just to give you some sense of where each of the fields are. So the West Brentwood field is where the VG3 and VG4 wells were drilled that generated those very substantial volumes of production. I just want to highlight again, when we talked about low technical risks, one of the pushbacks that we did have is how can two London-based guys go over to California and claim something is low technical risk when it's been picked over by the rest of the industry. I'm hoping that this highlights what is underpinning the opportunity we have, which is the difficulty capital has in being attracted to the right type of opportunity because it is so disenfranchised with the returns that have been generated by our space. That's really why we have these opportunities. In a little bit more detail here, I wanted to talk about the two areas, Munro Swell and West Brentwood. The lower panel you have on the left-hand side, on the right-hand side of this slide is the West Brentwood field. Now the two black arrows are pointing to the two old stroke historic producing wells. VG3 and VG4, the two wells in red, are essentially up dip from those two locations. So why was an up dip well never drilled before? Because the first place you'd go to after having produced from a well is in an up dip location if you could. And that's because the 3D seismic data was not acquired at that time. And combining the 3D seismic data that we had the benefit of looking at with the historic production is what put it into the very low technical risk category. The same is true for Munro Swell. The thing I want to highlight here is I don't have scales on these maps, which is a shame, but the Munro Swell area is aerially much more extensive than is the case for West Brentwood. The little black dots that you have on Munro Swell are all the old producing wells. If you see on the northeast corner of that map, there are lots of black dots, and that's where the field was drained against the fault in that northeast corner. We're going in the more central location and essentially chasing that very same play, but where there have been much fewer wells drilled, again, because the granularity of the reservoir could not be seen in the trapping configurations that we now see as very low technical risk. This is a bit of an update on Coulter. You'll have seen some of these slides before. I just want to reiterate a couple of quick things. BP, on the lower panel you'll see here, BP has already drilled the discovery wells back in the 1980s on this field. One of the difficulties they had drilling long deviated wells, because they drilled it from the onshore location, was trying to target that key reservoir horizon. It's a little bit different for this well because it is being drilled with a jackup directly over the reservoir target. We're hoping it will deliver what the prognosis is, which is approximately 26 million barrels of oil equivalent. Coulter sits just south of the prolific Witch Farm field. I do hear from time to time the Bournemouth Echo claim they never want to see a barrel of oil produced out of the region. I would like to point out that I think they have the largest continental European European oil field that has produced, which is now approximately 440 million barrels. This is simply an extension, is simply the next fault box south of that very prolific field. The key aspect here is that the infrastructure does exist to be able to get the Coulter field into production, primarily because the operator of Witch Farm today, Perenco, produces mostly water out of the field, and that's why it appears that the infrastructure is underutilized versus capacity. There would be a very sensible transaction for both parties that creates value for all parties. Having said that, we're constantly looking and evaluating at the best ways for monetization post-successful drilling here, and it won't necessarily be an asset transaction, but other forms of corporate transaction as well. This just gives you a bit of the economics associated with Coulter. The key thing I want to highlight here is how robust this is down to very low oil prices in terms of economic break-even. And I want to stress that is an economic break-even. The development capex is relatively meaningful here, and what we don't want to do is be too exposed to that part of the life cycle, because we are very clear in what Reabold generates the maximum return for its investors in. That is the low technical risk asset buying in at a very low price, proving it up, and monetizing it in the right format. This is Danube Petroleum. Again, similar sort of story. This is in the western part of Romania. The Parta license holds the Achia Mare field. The Achia Mare field produced lots of oil, but already had 2 gas discoveries on it, drilled back in the 1980s when there was no requirement for gas in Romania. That has totally changed today. Romania is a gas-hungry market. The 3D seismic data that was acquired subsequently was again the unlocking feature for the old wells that were drilled to really put this in the extremely low technical risk category. Reabold has funded the drilling of one of the appraisal wells of a 2-well campaign that will take place here for what is now a 33% stake. We also have negotiated a set of options that in the upside case, so in the success of that well, Reabold could go up to 50% of Danube Petroleum, paying a very small incremental price to the original entry price into Danube Petroleum. So it's kind of a leverage to the upside for very little cost. The economics here again are highlighting how low cost this opportunity is. But what it also highlights is that the development expenditure here is not so significant that Danube Petroleum at the Danube level could not really fund itself through various forms of debt or royalty in order to take this to the first stage of development. The reason I highlight that is there is a lot of running room associated with Romania, and the best point of monetization might not be after the first or second successful well, but just demonstration of the running room before we can then really crystallize that at the best point in its life cycle. Rathlin UK, this is quite an interesting one. Reabold Resources invested in Rathlin UK, which was at the time a subsidiary of Connaught Oil and Gas, which was a Canadian company. Connaught Oil and Gas drilled the West Newton discovery in 2014, and this was onshore UK. Given that it was onshore UK and the Deloitte CPR had approximately 180 BCF associated with it, you would have thought this must be the best discovery, because you could not put a gas discovery onshore UK more strategically positioned than this. Easington Terminal, CCGTs, gas storage facilities, and all of those have spare capacity in them. But given the state of the market, this project was not taken forward. There was an added complication here because the geology that is typically pursued onshore UK is not of this nature. It is very well known offshore UK, and you can take Shell's farm into Clough, Pensacola. This is that geology, simplistically speaking, but it is this type of geology. It just so happens to be onshore. It is much more de-risked than that particular target is because we have the seismic data and the historic well on here. Now the cartoon we have at the bottom isn't quite right because the next well will be drilled from the West Newton A1 pad location, deviated to a more crustal location for the appraisal opportunity, and it will also target a deeper formation called the Cade B, which potentially has oil in it. So the first discovery well found oil in a deeper part of the Cade B formation, but it was not of decent reservoir quality. Part of what we'll be doing here is testing that exploration upside. Just to stress again, all of the economics are predicated on the gas, but if in a few months' time we end up having had the oil discovery, I hope you'll forgive me if I say this is the best oil development opportunity that we have onshore UK. When we started this project 18 months ago, I think it would be fair to say there was a lot of skepticism as to what could be achieved within an 18-month period, or any period actually. We are here now 18 months on, having had the ability to point to very specific success of demonstrating low technical risk, of demonstrating that you can drill the assets once you provide the capital into them, and then being able to demonstrate monetization thereafter. I hope that means we've shown 3 ticks in those boxes and the fact that the projects can generate supernormal returns. Because of that, it's pretty clear that Reabold's in a position now where the number of projects that we are approached with has increased significantly. In part, I recognize benefiting from the glow of the recent success. But we always test the opportunity to invest in new projects with what our own share price is and our existing portfolio of opportunities. And we have to make both work to ensure we constantly generate value for our investors. I would stress the three previous raises we did were at ever higher share prices, demonstrating the progression that we had achieved in the portfolio. Final point is that since Stephen and I joined, we've strengthened the board. Peter, who we've added on this slide, Peter, you can give us a quick wave at the back if you don't mind. I apologize, but you know. So Peter is an advisor to Reabold, not on the board, but acts an advisor, and has been an invaluable sounding board with many years of experience and recognition for what he's been achieved. And his support both at Reabold and before we started Reabold has been invaluable. But since that time, we've also added 2 new members. One who's Mike Felton, a fund manager with a focus on growth through his career as a successful fund manager. I highlight that because the type of growth strategy we are deploying is the type of investment he would have made. And specifically, he wants us to adhere to the 3 key points I highlighted initially, primarily this ability to generate supernormal returns and constantly expose our shareholders to that part of the life cycle. We also added Marcos Mazetic, and this was a real coup for us. Marcos established the Global Exploration Department for Repsol. He headed that department and oversaw one of the most remarkable transformations in upstream oil and gas for a super major, where Repsol had the highest reserve replacement associated with many of the discoveries that were made in Brazil, including the Campos, the Santos, and this is things like Lula, Sayat, Gavia, and so on. The fact that he has joined our board providing the technical oversight has been a huge coup and, as I said, very valuable to us. Right, I don't want to go through the summary because I think I've summarized everything already, but I hope as I stand here today and reflecting on everything that I had said in the past, we have delivered on each of those points. We continue to deliver on this, and we really believe that we are at this exciting time of accelerating Reabold to the next phase of growth. Thank you very much.
Thank you. Do we have any questions at all?
You put quite a lot of emphasis on the point that you exit and the point on the value curve. How are you so sure that you're exiting at the right place on that value curve? What do you guys do to...
Look, I don't know, but here's how I would characterize it. When you make an investment in the pre-cash flow asset at the point that it is deemed not to be worth investing in, you're buying it at basically next to nothing, right? If we can show that there is some multiple of some, and typically these multiples are between, I don't know, 3 and 10 times, to give you an example, that's where I can deploy an incremental pound. If I have a development project, if I'm really lucky, I can maybe make twice my money. And when I evaluate what is the right time and how much money I leave on the table here, I'm constantly looking at how much I can deploy here to generate between the 3 to 10 times. So it's as much a relative question as it is an absolute question. But the point I want to try and get across is that even if the project is fantastic, that is not what is driving the decision making. So it's not about squeezing out the last pound of value on the development side of the life cycle. That's not what it's about. It's about that relative value, or indeed returning it to our investors. So sorry, it's not a hard answer, but I'm sure there will be times when we do give up value. But as long as we can show we're deploying it for something that gives you much bigger bang for buck, we'd be forgiven for that.
A question at the back. You haven't asked one today, so.
I've been very quiet. Gaelic Resources, part of that transaction, I think you issued them 440 million shares. 25% they're allowed to sell within the first 6 months, and there are lock-in for the rest until about the 12th of January. I noticed on your shareholder register They're not there, and that was dated the October 2018. There's been no holdings RNSs related to them. The share price has been held at this price for some months. There seems to be a big seller in the market. I'm trying to put 2 and 2 together. Am I making 5?
Okay, so I think there's 2 parts to the question. The first part of the question is, why have we not got on our shareholding list Gaelic or the underlying owner of Gaelic? So this is a bit of a technical answer and not that helpful. When we put out when Reabold puts out its shareholding base, and if we are to pass it through the regulatory requirements, the only way we can absolutely definitively show we have got the data is through the TR1s that are released. But the TR1s are typically released by institutions. We cannot force a TR1 to be released. If you go to a registrar and you try and get a download of every holding that they have, you can't tally the numbers up because you only get custodial information for many of the holders of the shares, and you cannot tie that back to the underlying investor. Given the fact that Reabold has gone through the cycle of raises that has taken place, it's extremely difficult for us to definitively give the answers without only relying on TR1s. So the safe option that we were advised was just to use the TR1s. That's why someone like the underlying owner of Gaelic doesn't appear on there. Next question, is Gaelic the seller or the underlying of those shares? I don't believe so, but again, I mean, they are now, as you've pointed out, free to sell those shares. And this is coming from our best understanding of intelligence as to who the seller is. And to be honest with you, I don't know the answer to that question. Is it Gaelic? I don't think so, is all I can say.
Any other questions?
Hi, Sachin. Your investment in Corallian is around, I think, 33%. But Corallian, you've only shown Wick and Coulter. You have Corallian have a lot more assets than just Wick and Coulter. Can you comment on those?
Yeah. Thank you very much for the question. Right. So just a quick point about this presentation and our thinking and the way we communicate to our investors. What we put up on the slide are projects where we have funded them and we know that drilling is taking place in a relatively short period of time. Right? Clearly, there have been extensions and we've run on from that, and I appreciate that. But we're pretty definitive about that drilling taking place. The NPVs we associated with that are because we have some kind of confidence then on the monetization route that takes place after that. What we are always working on are options that exist within the project portfolio we have right now. But only at the point when they get funded do we put them up here for you to see them. So it's not to say, that's it, we've stopped and, I'm just waiting for the results to come in now, at all. Now, you asked very specifically about Corallian. So there's Curlew and Alton. Curlew did get farmed out. There was an announcement made by Talon, and Talon have demonstrated that they are really taking an interest in the North Sea. The North Sea is an area that's attracting interest, no question about that. And Corallian have built a meaningful portfolio there. We believe that interest will filter through into those projects, and I do very much hope to be able to put 2 of the projects up here in a few months' time. But all I can tell you right now is I hope that we can do that. It's not definitive. But we do work them, we work with them, and are in constant dialogue about the best ways to move those forward.
You're being conservative, is what you're basically saying.
I'm trying to be fair, James, and it's worthwhile saying. Part of the reason we're able to buy opportunities so cheaply is that the level of distrust is so extreme. Every time we talk, I want to be able to stand up here and say, what I said last time is what's happening now is what's going to happen next. I don't want to be in a position where we lose that trust.
Gentleman over here. We have a couple more questions.
you say you've got an NPV of 394 million, yeah? You've got 3 new directors on the board with lots of experience. The window of opportunity is there still. Are you still looking for more opportunities?
So the answer to your question is yes. We are looking for more opportunities, and we are looking at them now. The question is always going to be, when is the right time to invest in them? And both of that have to marry up. So what we don't do is we don't say, okay, right, today is the day I'm going to go and look for a series of projects. And then tomorrow, once I get them, is where do I get the money to invest in them? And then the day after that, we constantly keep the project portfolio as alive as we can and being as honest as we can about being able to fund them given our current resource. But equally, as monetization starts to happen, we have to be ready to pounce on them. Or if the market is, if our shareholders want to support something, us to do something, we'll do that. So it's a constant and regular dialogue that we are evaluating all the time. But I can't give a definitive answer that we're definitely not going to or going to do something. It's just part of the process that we have been doing for the past 18 months, and we will carry on doing it.
Time for one more question.
Sachin, you talk about monetization. Can you give us some clarity on what monetization really means? I can see short-term monetization of cash flow from the California assets, but in terms of big developments, what are your monetization plans and how soon could we realistically expect to see those?
Yeah. Thanks very much for the question, Peter. So the portfolio has been built up with two broad types of asset categories or project categories. The first type of project category are ones where you can put them into production and actually point to the fact that I'm getting a very quick payback on the capital that went to the ground to drill the well. The reason that's important is because kind of almost come what may, you know you're going to be getting that cash flow in to keep everything going, right, over difficult cycles. There's another group of assets where on successful drilling, the likely outcome is some form of asset sale, some form of potential IPO of company that owns the asset, or other form of underlying transaction that really determines monetization. But that has factors outside our control in a way that the production assets don't, i.e. they're much more in our control. But on the point of monetization for the assets that are the big bang type assets, we've invested in the operator of the company. The reason that's important is the strategic decision-making for the exit is really important to be in dialogue with the operator about than if we were to go on as a joint venture minority on the license, which is a key aspect of why we've taken the decision to do that, and why either Stephen or I sit on the board of all of the investee companies. Exit, although we can't predefine it, is a critical aspect of our thinking for a strategic point of view when the investment is originally made. I don't know if that answers it sufficiently because I can't tell you how it looks, but all I can tell you is the way we structured the agreements and our involvement is very specifically to try to achieve the best outcome for the point of asset or company transaction.
Sachin, will you be able to stay behind
Of course.
afterwards? So if there's any more questions, Reabold Resources. Thank you.
Thank you very much.